Chris, we're roughly halfway through 2025, and despite the uncertainty, we're still near record highs. So what's your outlook for the second half of 2025?
Yes. So the first half was quite a roller coaster, but as you say, we're basically right back to where we started from. And our outlook hasn't really changed. We're cautiously optimistic on the outlook for the economy and corporate earnings, but acknowledge there are risks that investors have to be aware of. And I would expect that the volatility will continue in the back half of the year.
And one of those risks is trade. So how is America's tariff policy, I should say, America's ever-changing tariff policy affecting the way you invest?
Yeah, this is, I think, the key to the second half outlook is, are we going to get trade deals, or at least the understanding of what trade deals will be, so that the tariffs that have been announced are either lowered or eliminated going forward? And I think investors are going to be keyed on that because they seem to be looking through the tariffs at this point to a better back half of the year.
Investors are also watching the strength of the consumer and whether they're going to remain employed. What are you watching when it comes to consumer sentiment?
Yeah, so tariffs play into this. We've seen deterioration in both consumer sentiment and business optimism in the first half. And what we're watching going forward, is that a precursor for things like employment growth and inflation and GDP in the second half of the year? Or we have seen some softening, but it continues to power through. And our belief is that the US economy came into 2025 with so much momentum, it allowed it to persevere through all the headwinds in the first half. And we continue to believe, barring something unforeseen, you're going to see that continue to happen in the second half until the stimulus from the budget bill can start to kick in.
All right, American consumers are going to keep spending. So what should American investors be doing? So where are valuations right now? What are you buying?
Yeah, another really interesting question here, right? Because with the rally we've seen, valuations have moved back up to the high end of the range. At the same time, we've seen earnings estimates started the year about 12.5% for the S&P 500, and expectations are down to 9% as CEOs have been somewhat cautious. But what's masked in that evaluation is that it's very much influenced by the big top 10 names. And the other 490 names are much more interesting from a relative standpoint, but they also are starting to see earnings growth, which they haven't. So when we talk to advisors about how they should allocate their clients' capital, we're saying, yes, you still want to own tech, but this is the year that diversification's back in vogue. Other sectors, other asset classes, including international.
In the first half, international stocks have done very well, outperform U.S. stocks. Will that continue in the second half when traders get back from the Hamptons?
I believe that international still needs to be an allocation in portfolios, and we've heard it for years, right? International stocks are cheap. What I always say is cheap is not an investment thesis, but cheap with a catalyst, that starts to get interesting. And we're starting to see those catalysts. Germany was first with increasing spending on defensive and infrastructure. You've seen the same from Canada. So I think that you're starting to see fundamental improvement, which will drive earnings growth over there. And if you get cheap stocks with improving fundamentals, investors are going to pay attention.
And then finally, what are you seeing from the fixed income market? We've seen the 30-year hang around 5%. We've seen the 10-year hang around about 4.5%. If those start moving up, how will that affect your outlook?
Yeah, so another wild ride in the first half in the bond market, but we ended up basically right back where we were. So we're looking at it two ways. Yields currently, they provide some interesting opportunities for people that are looking to save money or even for retirees. But given the focus on the fiscal position of the country and the deficit, we are cognizant that you could begin to see rates tick up in the back half of the year, and there will be a level that weighs on equity investors. But at the same time, when we talk to advisors on the fixed income side, there are opportunities. Be diversified across durations and be ready to look at what the headlines tell you.
All right, well, thanks for coming on and talking about it.
Oh, glad to be here.